When trading CME Group listed futures and options, understanding margin requirements is essential. For decades, SPAN, short for Portfolio Analysis of Risk, has been the industry standard for calculating margin. But markets evolve and so do risk models. That's why the CME Group has recently introduced SPAN 2, the next generation margin framework designed to bring greater precision and responsiveness to risk management. In this video, I will explain what SPAN 2 is, how it works, its key benefits, and what traders need to know as this new system rolls out. SPAN 2 is the CME Group's upgraded portfolio margining system that uses a more advanced scenario-based framework to calculate margin requirements. SPAN 2 builds off of the original SPAN models by incorporating real-time pricing and enhanced risk factors, which in turn increases its sensitivity to market dynamics. This makes margin requirements more reflective of actual portfolio risk, particularly useful for complex portfolios or periods of high volatility. How does SPAN 2 work? SPAN 2 simulates thousands of potential market scenarios using advanced mathematical models to assume the true risk of a portfolio. These scenarios account for price movements across curves and assets, volatility shifts, and cross-margining opportunities. The system then assigns margin based on worst-case loss across these simulations, giving a much more comprehensive view of a trader's risk exposure than older methods. This shift also allows for greater accuracy in margin calculations, as SPAN 2 is built to process data in real time and respond quicker to changing market conditions. The primary benefits of SPAN 2 include more accurate margin requirements, especially for portfolios with options or multiple correlated products, enhanced risk sensitivity allowing for more efficient use of capital, as well as greater transparency and flexibility for clearing firms and risk managers. This improved framework aligns with the CME's margin methodology and global best practices, therefore offering a more modern approach to managing counterparty risk. Who is affected? SPAN 2 impacts all participants trading CME Group products. For intraday retail traders, the transition may not be as noticeable compared to institutional and professionals managing multiple positions across assets or carrying positions for multiple days. However, it's still important to understand that margin requirements may fluctuate more dynamically under the new system. If you're an active trader managing multiple positions, or if you use complex strategies with options or spreads, SPAN 2 may affect how margin is calculated and monitored. To calculate and monitor margins, this can be accomplished using the CME's complementary margining calculator on their website called CME Core. SPAN 2 brings a more robust, real-time, and risk-sensitive framework to CME Group's margining. At EdgeClear, we're here to help you navigate these changes. Whether you're managing a large portfolio or trading spreads across a variety of asset classes, we can help explain how SPAN 2 could affect your trading day to day. If you want to learn more, contact us through the link in this video. Thanks for watching, and we'll see you in the next one.